John Clark with Clark Energy Consulting.
Outstanding. Thank you for joining us here today. It's time now for our weekly OG brief, our oil and gas update. John Clark, Clark Energy Consulting, is going to be giving us the lowdown, or the OG brief down, if you will. How are you doing today?
Doing well, Jason. How are you?
Doing fantastic, and thank you for asking. But the world of oil and gas, it's so hard to predict these days. So, John Clark, thank you for joining us this week for the oil and gas brief, OG brief, if you will. So let's get to it.
Yeah, Jason. Well, last week and this week, the big three oilfield service providers, that would be Schlumberger, Halliburton, and Baker Hughes, reported their 2019 earnings. So what I saw in those earnings was actually interesting. The OG brief I posted this week, titled Shale Slump Signals Services Seek Elsewhere. International Oilfield Services behemoth Schlumberger reported a $10.1 billion loss in 2019, compared with a $2.2 billion profit in 2018. The company is responding to the ongoing shale slump by selling underperforming assets, idling frac fleets, closing locations, and laying off employees. It's interesting because the CEO actually commented that after 2 years of strong growth, North American revenue fell sharply, driven largely by the land market weakness affecting our one-stem pressure pumping business. So pressure pumping, if you're not aware, is basically the pumps that are used in the fracking process. So my background in oil and gas began in fracking, which is a stimulation process that's used to unlock oil and gas from shale rock, which directly contributed to the U.S. becoming the world's leading producer of oil, currently at 13 million barrels per day, more than doubling in the last decade. It's funny, there's an article in USA Today titled, "Have you hugged a fracker today?" They're going to need it because the way I see this year going, the service companies are losing profit in U.S. shale and focusing on international and offshore markets. So that's pretty telling for me that, the service companies are basically shifting focus towards international markets. So I see the, weakness in shale for 2020. If the service companies are facing weakness, the E&Ps, or the exploration and production companies, are ultimately being more disciplined in capital, drilling and completing less wells. And so I see the market for this year being pretty flat or maybe declining compared to last year for the services space. Interestingly enough, oil prices fell this week, dipped below $55 a barrel per today as a result of rising U.S. inventories. This is despite a major news that Libya had an outage on their production due to force majeure, basically meaning they couldn't keep up with their contracts. So the market is still digesting what that may mean, but ultimately the country produces 1.2 million barrels per day, and if they face a complete shutdown, that will be pretty significant. The rig count for this week actually increased 15, but we're still down 254 rigs compared to last year. So ultimately, the services space, is focusing elsewhere. I think E&Ps will have, continue to be disciplined in capital. And actually, next week, I will be releasing my Clark Energy Outlook report, where I'll cover outlooks for services and E&Ps in North American shale and offshore and international segments. And also next week, we have the E&Ps report their 2019 earnings. So ExxonMobil, Chevron, Murphy, and Hess will be reporting their earnings. And so I'll touch on that next week as well.
Well, we've been saying this on the program for a while. There's still money circulating around the globe, and it doesn't surprise me to hear that the big three service companies, especially going international to get some business, because the money's circulating across the globe now. A lot of people for a long time, knew it was circulating through the U.S., but it's global money now, and so you got to make a better steak sandwich than the next guy. But at the same time, you've got automation coming in, so you've got to figure out new markets and new marketplaces. So it doesn't surprise me that you're seeing some international play like that.
That's right, and there's more offshore rigs that are being added, and they're basically the reserves that have been produced have not been replaced from in conventional assets over the last 5 years since the downturn. So what I think we'll start seeing is more exploration in new frontiers, ultra deep waters. Apache recently announced a huge discovery offshore South America. I think the offshore markets will, the biggest ones will be Gulf of Mexico, offshore Africa, and South America. But also China recently announced plans to drill in the South China Sea. So we're definitely offshore. I think there's a lot of potential for new exploration.
Yeah, I think as the automation again ramps up, the offshore is gonna you're gonna see more offshore too with automation. It's just what I mean. Common sense will dictate that.
Right.
Yeah, because you're talking about some safety precautions and that sort of thing, and just quality of work and etc. But still, every time I say automation, some people think of job elimination, but it just opens up a different market. That's the thing. It just opens up a different market. So instead of having maybe 4 rig hands, you have 2, but then you have a couple people that need to update software and create the software and et cetera, et cetera. So, okay, great. So we've got the OG brief, which was pretty much about the big 3 earnings, kind of a roundup of that, a recap of that. But then also you mentioned the Clark Energy Outlook report will be out next week. So just kind of in summary, anything we missed, anything you want to reiterate, anything that we want to preview or plug, just kind of take the final thoughts, if you were, and take them whichever direction you'd like.
Yeah, I mean, the oil and gas markets have started the year quite volatile. I think what will be, we're really looking at a price range for oil in the $55 to $65 per barrel range. And I think the first half of this year will remain soft. We may see some strength in the second half, but we really need to see oil prices sustain $60 or above in order for activity to grow. I think, that goes, really excites me for 2021. I think this year, is going to be a little bit slower than last year. So, stay tuned for the updates. And, my focus is to help busy industry professionals stay tuned and be able to filter out some of the news to, really what the markets are actually doing. And with kind of a global intent, oil and gas is traded globally, like we've talked about, and it's needed all over the world. So it's not going away. But I think we just have so much production in the U.S. and it's starting to shift internationally.
So do you got a website, newsletter? How do you make money? Go ahead and give yourself a plug here for sharing the information you got with us.
You can go to clarkenergyconsulting.com. There's also a LinkedIn page, Facebook, and Twitter. And please subscribe if you can receive the weekly OG briefs by email. And you can also download a free copy of the Clark Energy Outlook report as soon as next week.